Welcome back to our webinar series. Matt Cashman from the OIC. Hey, Matt, how have you been?
I'm good, Jeff. How are you?
I'm good. I'm good. Always love having you come by and talk options. And so what do we have today?
Today, we're going to talk about options in elevated volatility regimes. It is not lost on me that for much of the month, last month, the VIX was trading in the 16 handle. So this is not going to be perfect for anyone who's going to be watching it and thinking that that's going to be there forever. But the one thing that I do know is that things don't always stay the way they are. So it's a good idea to think about how options move when vols go up as well as down.
Absolutely. And I'm just going to throw in our disclaimer real quick while we're talking. If everyone can just take a minute or two just to kind of read through this real quick. And then what we'll do for everyone listening is we're going to save the questions till the end. If you notice on your webinar, there should be first of all, there is a copy of the deck that you can download under handouts. Definitely a good resource material. Also, if you've signed up for this webinar, and people always ask, do you get do we send out a recorded copy? Absolutely. So if you've signed up for this webinar, whether you're here live right now or whether you weren't able to make it, something came up, if you're on the list, you will get an email later today with a recorded of this webinar. Also, you can always go back to our website, find previous webinars we've done with Matt and other contributors, and kind of peruse those and get ones for your interest as well. So Matt, on that note, I'm going to turn it over to you. Just bear with me for 2 seconds, and you should be able to share your screen.
All right. Oh, hold on. Let's make sure we're sharing the right screen. Let's see. Do you have this?
Oh, I do. Yep. Looking good.
Yeah, there we go. All right. All right, thank you, Jeff, for that wonderful intro. It's always a pleasure to see you. For those of you who watch a lot of this stuff, I don't usually get to do webinars with Jeff, so it's nice to do one with Jeff instead of Andrew. Andrew is otherwise indisposed, but I wanted to thank everyone for coming today. Thanks for joining us for the OIC and IBKR webinar. We're calling this Options in Elevated Vol Regimes. We're going to talk about elevated vol regimes, what they look like, how you can spot them, how you can think about them, and then the real important part, how you can think about the options and how they might move within those vol regimes. This topic may not seem very pertinent today. Like I said earlier, the VIX is trading in the 16 handle, but I assure you, as someone who's been trading for a long time, things don't always stay like that. Understanding how the options might move in a rising volatility environment and how those implied vols and the options are moving is going to be something that is going to keep you prepared for situations that that you might not think are on the horizon, but I guarantee you, in some way, shape, or form, they are out there. Looking at the options pricing and how that pricing is giving an idea of future expectations also, which we're going to touch on in this presentation, is always a great way to impart a deeper level of understanding about how the market makers are pricing options and how the market is pricing options most broadly. So I hope I can help you with some of that today. My name is Matt Cashman. I'm the Principal of Investor Education at OIC, the Options Industry Council. Quick background on myself. I started trading in '99. I've traded options ever since. I traded in London for a little while and then came back to the United States and started an index options market making business on the floor of the CBOE that I ran for about a decade. Wound that down in 2015. Took a little bit of time off during COVID and came back and started with OIC, leveraging all the experience that I have as far as options are concerned to help teach people about options. So very quickly, our disclaimer, you get the idea, very similar to IBKR's disclaimer. These are the trademarks you're going to see used throughout the presentation. Okay, here we go. This I want to draw people's attention to because it's important. Optionseducation.org is the website where we host all of our educational resources. They're free and available free of charge and on demand if you if you create a login and password. That's all you need. You're going to find courses, podcasts, webinars, videos, all kinds of things there. The other thing I like to draw people's attention to is this email address, options@theocc.com. That goes straight to the investor education desk where I sit with 3 other colleagues and we answer questions about options all day long, every day. So send us email questions, particularly if you have questions about this deck and the presentation that you don't get answered at the end. Make sure to send them to us and we'll get you an answer. This slide I always include because I think it tells the story of where we have been and where we are and where we might be going as far as volume is concerned. 2008 right here was 3.7 billion contracts of cleared volume at OCC. I want you to contrast that with last year, which was north of 12 for the first time ever. 12.3, 12.4 billion contracts of OCC cleared volume. This year, we are already over 10 billion, and we are averaging north of 55 million contracts a day, which should probably put us close to 14 or 15 billion contracts. It makes what we do as far as education is concerned that much more vital to make sure that people understand how options work, because there's a lot of them being traded. So let's talk about how we're going to get you through that education. We're going to talk about framing elevated volatility. How can you think about it? What do you do? How do you think about it when elevated volatility becomes a feature of the landscape and not something that just blips on your radar? How do those strategies shift in those situations? I'm going to talk specifically about delta, gamma, and theta and their relationship to implied volatility, because I think that's really an important building block of how you understand how those things move. Talk about different ways the term structure might move, which is something that's really interesting that people don't pay very much attention to often. And then I'm going to help you with building a picture of implied vol versus historical vol and thinking about tail risk. We've got a lot to cover today, as you might tell. Hopefully we'll have some time for some Q&A, but let's dig right in. Framing elevated volatility. When you think about normal price distribution, what do you think about? You think about this. Think about the bell curve. It's very simple. You see it everywhere in nature. You got graded on the curve in college. This is something that's in the marketplace all the time, and it's a basic assumption of how we think about pricing. What that means is that we have different ways to think about how far away from the mean we are, and it's all based on this normal price distribution. What happens when the market goes bananas? How is it different? The normal price distribution that I just showed you is very ingrained in the marketplace, but how does it change when we start to see things move around a lot more than normal? That's how you can think about a volatile market relative to a really normal market. And the idea I want you to take away from this is flattening, broadening and flattening of the possibilities of price iteration, of different settlement prices that might not have been on the horizon before are now a part of that price distribution. This area over here, this area over here, these 3 standard deviation, 4 standard deviation, 5 standard deviation away from the mean areas start to take on more of a likelihood in these fat tail distribution models, in the way that you see differing prices come into the melee, as it were, as to how and where the stock or the index might settle. So let's think about that as just the baseline idea. When implied vols go up, generally things flatten because of this. Price distribution flattens when things get volatile. We're going to see this throughout this presentation a couple of different places, and that's why I draw your attention to it early on. Let's talk about when volatility becomes a part of the landscape and how you can think about it. Standard devs are what, generally speaking, traders use to talk to each other about market movement. If you talk to 2 people that are really experienced option traders, they're going to speak in terms of probabilistic distributions or standard deviations. They're going to talk to each other about how far away from the mean things are now or might be later. Standard devs are a statistic that measures the dispersion of the data set relative to its mean, and it's calculated as the square root of the variance. It's the average of the square roots of the variance. It's reflective of the volatility of the underlying asset. So higher standard devs imply greater price variability, and it can really be helpful in gauging how you think about expected movement in the underlying. Standard deviations are directly correlated to implied volatility levels. What that means is that implied vol levels, when they go up, are implying larger standard deviations that are farther away from the mean. When we talk about that, we generally like to talk about things in terms of the rule of 16. How do I calculate a standard deviation? The rule of 16 is a way that we use to calculate annual implied volatility metrics using those annual numbers. So anytime you look at an implied vol, it's an annual number. The problem with that is that you don't trade in annual blocks, I'm guessing. At least I don't, or at least when I was trading, I didn't. I trade in hourly, minute, daily, weekly blocks. How do you take an annual number and break it down into something that you can actually use? You use the rule of 16. You can think about it as breaking down an annual number into daily standard deviations and how you might think about how much something is going to move based on its implied volatility. What you need in order to calculate a daily standard deviation is 3 pieces of information. You need the implied volatility of the option that you're looking at. You need the stock price or the index price, the underlying price, and you need a square root of trading days or a square root of time, some way to subset that ratio that we're talking about into something you want to use. The way that I think about this is I think about this top section, implied volatility times stock price. I talk about it as the big block of variance. The reason why is because what you're doing is taking the stock price of what you have, the implied volatility that, remember, is an annual metric, you're multiplying them against each other. And so what you end up with is implied vol annual metric times stock price gives you the amount of variance that you can expect for the entire year. Now, again, does the amount of variance for the entire year do you a lot of good if you're thinking about where to hedge your position tomorrow? No. But then what you do is you take that number, the big block of variance, and you divide it by some amount of time. Now, we use the square root because we have to take the variance part out of it. So you're dividing by the square root of time. In this case, we use the square root of trading days, which is 15.879, I think, something along those lines. We rounded up to 16, which is why this is called the rule of 16. There's 252 trading days in a year, and the square root of that is basically 15.8 something. And so that's why we use 16. Let's talk about this in real terms. $100 stock, 20% implied volatility on a 30-day option. Let's think about how much movement this implied volatility level is forecasting for any average day during that duration. Remember the standard deviation formula I just gave you. Daily standard dev, implied vol times stock price divided by square root of time. In this case, trading days. So what do? We take that 20 vol, we convert it to a decimal, 0.20. Multiply it by the stock price, 100. It's a $100 stock. Divide by the square root of time. In this case, the square root of 252 or 16, what you end up with is 20, which again is that big block of variance. You can expect that that thing is going to move around 20 bucks for the next year, or that's what the forecast is. But I want to look at it in terms of how much it's going to move on a daily basis as far as this is concerned. So I divide by the square root of trading days, which is 16, the rule of 16. What that spits out to you is a number in price terms as to how much you might expect that stock to move on a daily basis. Daily standard deviation in this case is $1.25 per trading day. That's a $100 stock with a 20% implied vol. Really tells you that the market is expecting, for however long those options are alive, that this thing's going to move $1.25 per day on any average day. Now, that's not a guarantee that it's going to move $1.25 per day. That's the forecast that this vol is telling you. So that's how we do that as far as the standard deviation is concerned. The way that standard deviations can be used is that you can use it as a framework for evaluation as to what the market is considering and not considering going forward. Remember what we talked about, $100 stock, 20 implied vol, 30 days until expiry. You've got $1.25 of implied standard deviation. Now let's assume on some random day, the stock is up $7. You walk out, everything's fine. Something comes out after the close. Stock moves $7. Positive corporate news. So it's up. Stock's now trading 107. Okay, now let's also suppose that during this move, implied volatility of the options goes up. Instead of a 20 vol, now we're dealing with a 40 vol. Now, there's more demand for options. Obviously, that's part of the reason why the implied vol is going up. Now we have, remember, $107 stock, but the implied vol is now 40. We have 29 days to expiration because we're on to tomorrow after the news has come out. And what is our new standard deviation? Do the math, $2.67. Now, that's the exact same formula that we used before, but instead of 100 times 20, we're doing 107 times 0.40, and we're dividing by that same square root of time, 16. That gives you $2.67. Is this reflective of your expectations for the average daily move going forward? These options are very, very different from yesterday's options on a 20 vol. And I want you to think about this in terms of, if I'm a market maker and this stock is trading 107, it's a huge difference to expect $2.67 of movement out of it on a daily basis than it is $1.25 on a daily basis on that 20 vol. Is that reflective of what you think as far as the options are going to do going forward? Because that's really what you're dealing with now. And so I want you to think about this in terms of what the actual implied vol is forecasting, break it down into how much movement is necessary on a daily basis in order to justify this implied vol, and then think about whether or not that matches how you think about the options going forward. So when we think about this $7 move from the previous example that we just gave up, it moves $7. That's 7%. That's a big move. But I also want you to think about it in terms of, if you frame it within the idea of standard devs, when we started, that standard deviation was $1.25 per day. And so a $7 move is more like 5.6 days worth of movement built into one tiny move, one not so tiny move, as the case may be. And so you just witnessed a 5.5 standard deviation move. Does this change the way that you think about the options going forward? If you were long options, does this change how you think about it? What about if you were short options? Because I can guarantee in that situation, if you were long optionality, you probably made money. And if you were short optionality, guess what? You probably lost money. But does it change how you think about the options going forward? Because whether you made or lost money, the options are priced on a different vol now than they were to begin with. Let's talk about how strategies shift and why they shift. Because one of the things that people, I think, don't think about enough is how the Greeks are related to implied vol levels. Delta as a function of implied vol. I'm going to walk through delta, gamma, and theta, basically, and talk to you about how those are related to implied vol. I'm going to try to give you the same scenario in all three so that you can understand exactly how this works. We're going to take the same options and I'm going to run through what they look like on a 20 vol, a 40 vol, a 60 vol, an 80 vol, and a 100 vol. And the reason why is I want you to think about what's happening to these options as vol goes up. Now, remember what I said at the beginning. When we're talking about vols going up, I want you to think about flattening and broadening of price distribution, because that's really what's going on. But when we talk about it in terms of delta, it shows up in a really interesting way. So this is a $60 stock. This is your at the money right here, these $60 options. That means that these 55s and lower are in the money calls, and these 65s and higher are out of the money calls. As you see, with a very low implied vol, a 20 vol in this case, for a $60 stock, these options down here have a very high likelihood of staying 100 delta. That's what the market is telling you. These all have very high deltas, almost 100 delta. And these options have very, very low deltas. The out of the money calls have almost 0 delta, very quickly outside of those at the money options. But when you raise the vol, this is a 40 vol. Same exact thing, but a 40 vol. What happens to the delta of these options? The delta starts to come down on these in the money calls. Why is that? And these deltas start to come up on the out of the money calls. Why is that? What happens when I move it to a 60 vol? It does it the same exact way. Things are starting to move closer to a 50 delta on both sides. And if we go up to an 80, it gets even more acute, and 100 even more acute. That's what's happening here when we talk about flattening of delta. The reason why is because when you think about volatility, I want you to think about the bell curve that we talked about at the beginning, the normal price distribution. And then I want you to take that situation, I want you to blow it out in your mind, essentially as far as you possibly can. Think about infinite vol. Think about things as infinitely volatile. I would like to say the closest thing I have to an infinite vol situation in my mind was 2008. And I tell this story all the time. When I was trading in 2008, I was trading S&P options in the pit. And if someone were to come up to me before we walked into the pit and say, we're going to settle 6 standard deviations away from where we were yesterday, before the market even started trading, I would have looked at them and said, okay, sure. Like, it happened last week, and it happened 2 weeks ago, and it happened 10 days before that. And like, it becomes something that just starts to seem commonplace. Moving that much starts to remove your idea of being price anchored to a certain area of the curve. And so what is happening in that situation is that you're mentally starting to build in the idea that all of these prices that are out there, all of the possible permutations of price, start to take on an equal likelihood of happening. It's like, are we going to move up 6 standard devs? Maybe. Are we going to move down 6 standard devs? It's possible. Who knows? It happened last week. And what's really happening here is that the actual price distribution is flattening. And as things flatten and vol goes up, what you're really doing is you're starting to make all of these options have similar characteristics. And that similarity pushes in the money calls delta down toward 50, and it pushes out of the money calls delta up toward 50. The main takeaway here is when you're talking about delta and implied vol is going straight up, all of the options tend toward a 50 delta. And so if you're holding in the money calls and you're short stock against them, the delta of that in the money call is going to go down when vol goes up. And if you're holding out of the money calls and you're short stock against those, the delta of that call is going to go up as implied volatility goes up. All options tend toward a 50 delta as implied vol goes toward infinity. It's important that you remember that, and it's a function of the flattening price distribution. That's what you're seeing right here. Let's talk about it in terms of gamma. Gamma is the exact same thing, except I want you to focus on gamma in 2 different ways. The first way is gamma relative to duration. Gamma relative to duration, I talk about this all the time. This is gamma of the at the money option with 0 days, right about to expire, 5 days, 10 days, 30 days, and 90 days. If you were to just look at this table, it doesn't really look that acute, the difference between 0 days and 90 days. It's like 0.15 or 0.015. Like, what's the difference? Okay, now graph it. It makes a huge difference. If you think about where all the gamma is, all the gamma exists in these options that are up in the 0 DTE space. Those are very gamma rich options. They don't have a lot of vega. They're not very sensitive to implied vol moves, but they have a lot of gamma. They're very sensitive to underlying moves. And so the first way I want you to characterize this is gamma relative to duration. How much gamma is in this option? Is it very gamma rich? Is it right about to expire and at the money? Or does it have 30 days in it? And maybe it's a mixture of gamma and vega. Is it something that's not quite as sensitive to underlying moves, but has a little bit of sensitivity to implied vol moves? That's how you get into options that are more vega rich as you go further out on the duration curve. But we're talking about gamma, and gamma as a function of implied vol. This is the gamma as a function of duration. This is the gamma as a function of implied vol. This is the same exact scenario that I gave you with delta: 20 vol, 40 vol, 60 vol, 80 vol, and 100 vol. And this is a $60 option right here, $60 stock. These are your in the money calls. These are your out of the money calls. When you graph gamma of options on a 20 vol, it has a very steep distribution, lots of actual distance, but it's not very broad. This is a function of what I told you about when we talked about normal price distributions. When you're talking about normal price distributions, you're assuming that most of the actual settlements of price are going to happen close to the mean. And so the gamma of all of those options is concentrated in those options around the mean. Now look what happens to the gamma of options as you start to raise the vol. That's what it looks like on a 40 vol. That's what it looks like on a 60 vol. That's what it looks like on an 80 vol, and that's what it looks like on a 100 vol. The thing I want you to notice here is the same thing that I've been talking about this whole time. As you raise implied vols, things flatten. That means that options that didn't have gamma before might have gamma now. But it also means that the options that are right at the money that had all the gamma in an environment where the vol is through the roof are going to have significantly less gamma than they had previously. For instance, look at this option right here. On a 20 vol, it has all the gamma. On a 100 vol, it's not that different than the option that's right next to it. The gamma levels start to flatten across the board. And the reason why is because the price distribution is flattening. All of these different price iterations start to become equally as likely. Remember, when vol goes to infinity, gamma goes to zero, essentially. When we're talking about an infinitely volatile environment, gamma is zero because there's no difference in the delta of all of the options. Remember what I said, delta all tends toward 50. And so if all the options have a 50 delta and you move from one option to the other option and you say, well, what did the delta do? And you say nothing, it still has a 50 because that option has a 50 and this option has a 50 and that option has a 50 and all of them have 50. Guess what? They have no gamma because the delta isn't going to change. And so that's what you're dealing with when you're dealing with implied vols going through the roof. That's why the gamma starts to flatten and everything starts to come down as far as gamma is concerned. All right, let's talk about its theta. Same situation. I had to move it to the 100 straddle in this case because the data was kind of crappy for the 60s. I want you to think about this as a 20 implied vol, 40, 60, 80, and 100. This is the actual price of the at the money straddle. 5 days to expiration. So $1.87 for the 20 vol. It almost doubles to $3.73 for the 40 vol. The 60 vol gives you a $5.60 straddle. The 80 vol gives you a $7.46 straddle. And the 100 vol gives you a 9.32 straddle. What that means is that as the implied vol goes up, the extrinsic value of those options is going up commensurately with it. But what that also means is that the theta is a function of extrinsic value. And so in this case, on the 20 vol, it might have 17 cents of theta. But on the 40 vol, 40 cents of theta, 55 cents of theta, 75 cents of theta, and 93 cents of theta. That is the measure of how much those options are going to decay in a course of a 24-hour period. The reason why is because if you have $9.32 of extrinsic value that's going to come out in the next 5 days, way more of it has to come out today than if it was $7.46. And as you start to add implied vol to these, the extrinsic value starts to go up, but the theta goes up too. So that's an important thing to think about when you think about this as well. As stocks fluctuate in price, shares can be bought and sold against it. You can scalp gamma against these situations when the delta of the options is changing because the underlying is changing. And in that case, two-sided movement is the best possible scenario for things to happen that way because you get to buy options, you get to buy stock below the strike and sell it above the strike and et cetera, et cetera, et cetera. However, When you're dealing with high vol environments, the theta of these options continues to erode their value. Theta happens per calendar day, not per trading day. And so you need to remember that even on Fridays and Saturdays, when the stock market is not technically open right now, theta is built into how those prices change over time. And so you have to actually balance the idea of how much this thing costs versus how much it's going to decay over a one-day period of time. All right, let's talk about term structure, because as I said in the beginning, when I think about this, oftentimes I think people miss the idea of what term structure is telling you as to how and why the options market is pricing things the way that it is. This is what I would say is kind of like a normal-ish term structure. Now, it's saying something very specific. It is telling you that the market expects a certain amount of movement in this 0-day bucket and this 5-day bucket and 10-day bucket that it does not expect for the entire 180 days in these options. And so when you think about this, I want you to think about what scenario might this be pricing? Like what kind of setup in the marketplace might this actually be a function of? Sometimes people look at this and say, well, this is a stock that's moving around a lot now that's not forecasted to move around later. And I totally agree with that. That can happen for lots of different reasons. It can be a broad-based market thing. It can be like, non-farm payrolls is coming out and it's going to affect the entire market. It can also be a very specific acute thing wherein this stock might be announcing earnings in the next 10 days. And so these options up here have more implied vol built into them than these options do back here. That's a possibility as well. I want you to think about other ways that the term structure might be structured and might be priced. Because in this case, we have two totally different shapes as far as the term structure is concerned. The first, that darker blue that we saw before, is really telling you that there's an expected amount of volatility in here that's not included back here. And what you're seeing on the light blue term is the exact opposite of that. The light blue is suggesting that there will be no theoretical movement over the next 5 to 10 days, but that there's a significant more amount of movement forecasted over the long term. Oftentimes when duration curves reprice, they will reprice in kind of ways like this. You might see, for instance, I can give you a great example. The dark blue line might be what a term structure might look like before earnings. And that light blue line might be what it looks like after earnings. I'm not guaranteeing that that's how it's going to happen, but oftentimes when you have events that are priced in as vol events, things that people don't necessarily know what's going to happen, what you get afterwards is what we would consider vol reduction events. Now, all of a sudden, you have a bunch of information that you didn't have before. Let's say earnings comes out, and now we know how much the earnings are and what the guidance is, and the stock didn't move. And so what you might have in that situation is all of that unexpected or all of that expected kind of tension that was happening in the front of the curve just totally evaporates. And in that case, you might see a term structure price in this way. But what you need to do is be able to look at this term structure, and even if you don't have this dark blue line that existed beforehand, to be able to look at this light blue term structure and say, okay, right now, the market is pricing in not a whole lot of movement. However, in the future, in the 180-day vol, there's a little bit more movement priced into how the options are priced. What does that mean? Do I agree with that? Is that part of how I think about this? And be able to make that assumption as well if that's what you're looking for. There's a third way that things kind of show up. We've seen this kind of like normal-ish vol. This is a vol environment in which the term structure is telling you there's not going to be a lot of movement right now. And then we have what I would call the 2008 term structure, which is basically everything is super high and there's no difference between any of the options in vol terms. And what that usually means is that the market is bananas and that no one understands or has any idea of what's about to happen. And so we price everything exactly the same. The green line is indicative of a market where there's a lot of movement happening and no one understands why, and it might last forever, but no one gets what's happening. And it's just like, as far as the market making is concerned, the first knob that you reach for is the implied vol knob, and you just crank it. And you just say, okay, turn all these options up to the point and raise them until someone sells us something, is essentially what you're saying in this situation. Or you might be reacting to a scenario in which someone came in and bought every single straddle on the board, and the vol goes from 40 to 75, and it goes there for every option out there. In these scenarios, markets tend to flatten their distributions. When people don't understand what's happening and are scared and things don't make a lot of sense, the first thing that they do is they raise option values and raise extrinsic values. And so that's what you're going to see in situations like that. Okay, let's talk about implied versus delivered vols, because this is a big part of how I generally think about markets and how many people think about how the markets react to these situations. What I've built here is something that gives you the implied vol and the delivered vol. The delivered vol is the vol that the stock has been moving over the last N number of days. And I'm giving this to you for two different stocks because I want you to release yourself from the actual idea of price anchoring as far as volatility is concerned. You'll see why in just a moment. So what we have here is the 10-day implied, the 30-day implied, the 60 and the 90-day implied. These are all implied vols, so these are all option vols for these different durations. In stock one, what you have is that first dark blue line that we talked about. You've got a lot of movement theoretically forecasted for the next 10 days and then very little movement in the 90 days. And in stock two, what you have is a different kind of idea about what the next 90 days looks like. And as far as stock two is concerned, the next 90 days, as far as the options are concerned, look exactly the same for the entire duration. Now, I want you to think about what this says when you put it in, like, when you bookend it against the historical vols. Now, this is just a scenario that I created in my mind, but I want you to think about it in this way. The 10-day historical vol, the 30-day, the 60-day, and the 90-day. You might notice that these line up with the 10-day implied, the 30-day implied, the 60-day, and the 90-day implied. Many people will look at this and say implied vol doesn't have anything to do with historical vol, and you would be right in some cases. Implied vol is forward-looking, historical vol is backward-looking. And so I do understand that we're taking two things and comparing them to each other, where one is looking one direction and one is looking the other direction. But if anyone has a different way to look at this, I would love to hear about it. In many cases, what I think about as far as this is concerned is that this is the best way that we have to kind of color our expectation of what's happening right now in front of us. So we have a 10-day historical vol in stock one that looks similar to its implied volatility term structure. 58 up front, 12 in the back. Meanwhile, stock two has basically the same historical vol for all of these periods, somewhere between 15 and 16. Now, what I am suggesting is that we take the implied vol and we divide it by the historical vol. The reason why is because I think that this gives you a really good idea of the ratio of those two things. And what I think it does is it allows you to think about this in terms of how much something is priced as far as movement is concerned and how much it has moved over the last same N number of days. What that gives you is the implied historical vol ratio. In this case, you have a 10-day ratio, a 30-day, a 60-day, and a 90-day ratio. Anytime you see this over 1, it's going to imply that the implied volatility is higher than the historical volatility. And anytime you see it under 1, you're going to see it implying that the implied vol is below the historical vol or below what it's delivering. Now, it's not always evident when these ratios move which side of the ratio is moving. That can be the problematic part here. And so oftentimes you need to dig into forensically when you see the ratio move, dig into why it's moving. Sometimes it can be the implied vol that's moving. Sometimes it can be the historical vol that's moving. But just seeing the ratio move by 5 points isn't going to tell you necessarily which one's moving. If the ratio moves up, it could be that the implied vol is going up. It could be that the delivered vol is going down, or it could be a mixture of both of them. Now, the thing that's interesting here is what they can tell you. When I said it removes some of your price anchoring, this is what I meant by it. These two stocks have the same implied historical ratio, 1.35, meaning that the implied vol is 135% of the historical vol. The important part here is that both of these stocks, even though one of them has a 20 vol and the other one has a 58 vol, both of them can have that same 1.35 ratio. That means, all that means, the 1.35 ratio, is that the implied vol is 135% of the delivered vol for that period. The same thing can happen if the implied vol is under the delivered vol. In this case, you have a 0.78 ratio, and this is like a 19 vol, but this is a 73 vol. And the 73 is lower than the 93 on the historical side, and so you still get that same 78 ratio, 0.78 ratio. That means that the implied vol is 78% of the delivered vol. And then you have a scenario in which both of these have, close to the implied and the historical are very close to each other, but one of them is a 15 vol and one of them is a 75 vol. This is meant to drive home the idea that just because something has a super high vol, implied vol, it doesn't necessarily mean that the options are a screaming sale. Oftentimes people will just look at it as 1 point on the entire curve and not look at everything else and just say, oh, it's a 70 vol, we should sell that. Well, in this case, the implied vol would be a 75, but the 30-day historical is a 72. Does it still sound like you should sell it? Who knows? But that tells you that this is only a 103. It's not as if it's like, 30 vols over what the stock is actually moving. When you start to look at ratios like this, you can start to track them over time, just like you do a stock price, right? You can see that this ratio can move around, but it's also important that you think about it within the perspective of not just the 5 days that you're looking at it, but think about it in longer term perspectives. Lots of times people like to look at this and think about it as, where does this ratio like to live? And a lot of times when people who trade relative value, they'll talk about it in those terms. Where does this ratio like to live? Like the implied vol likes to be 103% of the delivered vol, or 130%, or whatever it is. Start to look at that in a historical context and make some decisions about where you think it likes to live, and then understand why that is the case. Does it live there all the time? Does it live there only when there's expected vol events on the horizon, et cetera, et cetera? So let's talk really quickly about tail risk, because in elevated vol environments, tail risk starts to show up on the radar in ways that it doesn't in other environments. Tail risk is really the possibility of large unexpected moves in either direction that aren't necessarily accounted for by standard risk measures. It's like extreme events. Most of the time, colloquially, people think about it as 3 SDs or more away from the mean. And while these events generally are thought to be unlikely, they have asymmetrical P&L ramifications. And that's why people care about them, especially when vols get super high and when things start to get a little funky as far as the market moving around. Here's some tail risk events you might recognize. Black Monday, long-term capital management, LTCM, September 11th, the GFC, the flash crash, COVID, and I'm going to add to this Liberation Day from last year, I think, or maybe was that this year? It feels like it's been 10 years, but those are the kind of events that are tail risk events that have happened in the past. When we're talking about normal price distributions, which is what we're really talking about throughout all of this, I want you to think about the fact that one standard deviation away from the mean usually covers about 68% of all of the prices. If you were to pick a random price most of the time, 68% of the time, it's going to fall within 1 standard deviation away from the mean. 95-ish% of the time, it's going to fall within 2 standard deviations of the mean in either direction. And 99.72% of the time, it's going to fall within 3 standard deviations of the mean on either direction. Where's the tail risk? This is the tail risk. Outside of those 3 standard deviations, that's when people start to talk about these fat tail scenarios, where this starts to take on a higher likelihood rather than basically a 0% probability. That's what fat tails and tail risk scenarios really, that's when people start talking about them, that's what they're talking about. They're talking about 3, 4, 5, 6, 7 standard deviations away. Okay, let's talk about how you can think about this most broadly. Elevated vols can reprice the entire term structure in many different ways. Don't forget to look at the term structure as a way to interpret how the market is thinking about movement. Greeks that we just broke down, remember delta, gamma, and theta specifically, and how they are actually related to implied vol levels. As implied vol goes up, all deltas start to tend toward the 50 bound, and as implied vol goes up, gamma is negatively correlated with implied volatility levels. The higher the implied vol of an at-the-money option, the less gamma it's going to have relative to its classmates across the curve. Always important to remember that. Strategy attractiveness shifts when implied vols move around. People start to think about things in different ways. When you've got high implied vols across the board, people think about risk in different ways. And term structure carries a lot of information that I think is overlooked. People don't always look at term structure because they're concentrating on what the vol of the thing they're trading is. I'm long DECE options and the DECE vol is this. That's great. Put that on your risk radar and then also look at the DECE vol and the vol right next to it and the vol right next to that and draw a complete picture of what the term structure looks like, because it's telling you a lot about what the flow is pricing as far as options are concerned. And then always consider tail risk, especially in high vol environments. Elevated vol environments, not only should you be thinking about tail risk scenarios, but your risk manager and your brokerage firm and your trading firm are also going to be thinking more acutely about tail risk scenarios when vols go through the roof. Trust me, that's when things start to pop off in people's minds about, what about this? What about a 7SD move? It becomes part of the landscape more regularly when vols are much higher. So make sure to check out optionseducation.org. That is where we host all of our options education. And don't forget about this. Send us email questions at options@theocc.com. That goes straight to the investor education desk, where I, myself, and 3 other educators sit talking to people about options all day. So, Jeff, how do you feel about some questions? Are you there? I think you're muted. Or maybe not. Maybe not. Can you hear me? Okay. Well, I'll take a look at the questions. How about that? Let's see. Let me see if I can pull them up. Well, audio. Let's see. Nothing like a little bit of dead air, Jeff.
Yeah, I don't know why you can't.
Oh, there you are.
Oh, perfect. So, yeah, that's odd.
That is odd.
Anyway, so there's a question asking if the volatility and the Greeks, the theta, the gamma, and so forth, differ between U.S., European, and Brazilian options. And I mean, I would obviously they all those differ by each underlying to begin with.
Yeah.
But maybe the way to answer that, Matt, is the difference between U.S. style and European style options and how that might affect the Greeks. Obviously, one having early expiration, an assignment,
Sure.
ability and risk and the other European not. That would maybe be a general way to answer that, I would think, right?
Yeah, we could talk about that. I would say the number one thing that you should think about most generally is how the actual implied vol affects the Greeks of the options, because that is going to be fungible in some way across all of those asset classes that you're talking about, right? Whether they're index options or commodity options or Bitcoin options or whatever they are. Implied vol and gamma, or implied vol and delta, or implied vol and theta are all going to be related in the same way that we just talked about them, because that's a mathematical way that they're related to each other. Now, the thing that Jeff is talking about as far as American versus European style options is that there's really two classes of options in the listed space in the United States. One of them is the American option. One of them is the European style option. American style options are usually equity options, but American style options have what we call early exercise potential, meaning they can be exercised by the person who's long them at any point during the option's life cycle, up to and including the moment of expiration. European options do not have that built in. European options can only be exercised at the moment of expiry. And so, as you can imagine, that changes how things are priced between American style and European style options. If you have the same exact option and one of them has constant optionality as far as early exercise and the other one does not, which one of those options would you pay more for? The American style option, because you have constant optionality of being able to exercise it. This comes into play oftentimes with things like corporate actions or dividends in the actual equity space, because people want the ability to actually exercise the options early before they expire. They don't want to have to hold the option all the way to expiry. And sometimes corporate actions can change significantly how options in that space are valued. Think about being long a call when there's a dividend, and then if you're long the call, you don't get paid the dividend, but if you exercise the call and you're long the stock, you do get paid the dividend. Well, that changes the value of the call, and it also changes the incentive structure for the people who own that call as to whether or not they want to be long calls or long stock. So that's the difference between American style and European style options, but I want you to make sure that you take away the mathematical parts of this, where implied vol and gamma and theta and delta are all related, because that part I think is fungible across all those asset classes.
I like it, Matt. And another question is asking, is there a way to convert the 1-year implied volatility to a time frame reference to the last month in a high volatility short-term scenario? For example, tariffs effects on stocks, commodities, etc. I'm kind of reading this, Matt, as like, taking the rule 16, but maybe like weighting it more toward, like, if you have sort of a anomaly with the vol versus just that's how I'm kind of reading that question. I'm not sure if I'm reading it. That's sort of my take on.
I think you're reading it correctly. Here's what I'm going to tell you. The rule of 16 works because we use the square root of trading days down here. Remember what I said? The top is this big block of variance, that's annual variance, and then you're subsetting it. You're kind of like slicing it into trading days by dividing by the square root of trading days. You don't have to use the square root of trading days. If you want to do it on a monthly basis and think about how much this thing should move on a per month basis, instead of the square root of 252, you can just use the square root of 12. And what that'll do is it'll subset that annual number into 12 individual blocks of variance, and you could think about it in that way. And that would be not a daily standard deviation, but a monthly standard deviation. And that implied vol, in that case, would equate to a monthly standard deviation that you'd be using if you use the square root of 12 instead of the square root of 252. You can also do it weekly. If you want to do it weekly, you could do the square root of 52. There's 52 weeks in a year, right? Like, you can use this in whatever way you want. Just make sure you understand what you're doing when you're altering that equation and using a different square root of time in the denominator.
And I think we have time for one more. Let me just look for a good one here. Here's a good one. If you are a net seller of option spreads in a low moderate VIX, like we have now, materially relevant, is a low moderate VIX material relevant when the implied vol rank and percentile of the underlying stock are both high. For example, if the implied volatility rank is above 60 and the implied volatility percentage is above 80, doesn't matter if the VIX is 16. So I guess, the macro versus micro, right?
Yeah, exactly. I think that's an interesting question because it doesn't necessarily, and I think we can answer this by saying the level of the VIX isn't necessarily indicative of anything other than exactly what it's measuring, right? Like, don't ever forget that the VIX is actually a measure of the at-the-money option on the 30-day option of the S&P 500. That's what that is essentially. It's a more complicated calculation than that, but it's basically that. And so when you're talking about the difference between the VIX and an individual stock's performance or an individual stock's implied volatility, that's what you're really talking about. And that gets at the idea of dispersion between larger implied vols in the index space versus their component pieces, which will be different in their individual stocks. However, I think the big thing that we should point to in this question is when you say I'm a motivated seller of spreads, because I would say in this situation, the biggest part of how you can kind of think about your risk is in the fact that if you're always selling spreads, you're already kind of defining your risk because of the fact that you're selling spreads. I'm assuming you mean you're selling verticals or you're selling iron condors or something. And if that is the case, then you're already kind of capping your risk in many different ways, right? And so I'm not saying that you shouldn't be looking at what the implied vols are doing. You should. But the strategy that you're already implying when you're selling spreads is that you're already kind of capping your risk and making it a defined outcome. And number one, I think that's a great way to approach it. But number two, it's also going to mean a little bit less as to how much the vol is moving, because you're not dealing with just selling naked straddles or naked options and big giant blocks of premium. What you're doing is defining it and selling it in a way that gives you a defined outcome. So that's how I would answer that.
No, this is great, Matt, and I think we're running up against the hour. But again, another great webinar, and also I know you're going to be swinging by our podcast studio later to speak with Andrew and do a podcast on a different subject. But again, always would recommend this to our listeners on this webinar. To podcast probably released by the end of the week, and go check out our podcast channels. Well, we got a lot of great stuff with Matt there as well. So again, Absolutely. Matt, thanks for coming by. I always appreciate you.
Yeah, thank you for having me. I really appreciate it. Have a good day.
All right, you too.